Hello everybody, Gbenga Olatunji here. We want to look at cash flow forecasting now, and when we are talking about cash flow, we must explain what basic items that we are going to meet when we are talking about cash flow. We are going to experience. We are going to have cash inflow. We are going to have cash outflow. We are going to have net cash flow. We are going to have closing balance, just as we are going to have opening balance. These are some of the things that a treasurer must meet and must deal with when forecasting cash flow and cash management. Good, as we jump into the topic right away, but some people may be asking, what are the things that we are going to meet in this video? We are going to learn about the advantages and disadvantages of having a treasury department. Don't forget that we started with treasury department, so we are going to talk about advantages and disadvantages of having treasury department, how to manage it, and don't forget this particular video centers on cash flow forecasting and cash management, which we are going to do justice to. So aforementioned, what is opening balance? An opening balance is a balance of cash that an organization opened with, maybe in the beginning of the year, or at the beginning of the month, or at the beginning of the quarter, depending on whatsoever they deem fit. So that is opening balance. And don't forget also that when we are introducing ourselves to the topic of treasury department and treasury management and who a treasurer is, we let us realize one thing, that to have a treasury department, it simply means that the organization must be a bit large. I want to believe you will agree with that. So one thing is important in cash management, therefore in treasury departments, there must be fund pooling. We must be able to pool fund together. What do we mean by fund pooling? Treasury department is to manage a lot of other departments in an organization, and let's say a conglomerate. We have different functions, we have different organizations under the group name. So there are so many organizations under that company, let's say holding company, that the treasury department is functioning on their behalf. So those companies, those functions, those departments, as the case may be, we have their own peculiar bankers, bank, financial institution that they bank with, which they've opened account with. So those accounts must be merged in order for the treasury department to have a cash balance as at the beginning of the month, beginning of the year, beginning of the day, for the organization as a whole. So that is a big deal of cash management approach in a treasury department. Having said that, so for us to have an opening balance, we may need to do cash pooling. That is pulling together of our cash balances from different bank and bank statements. Some may be deficit, some may be positive. At the end of the day, we have a single information and single balance. So that explains what opening balance or balances generally will be in the treasury department for an organization. Now, when we are forecasting to, another thing that will come up is total inflow. And total inflow, basically, as the name suggests, simply means the totality of the cash received that comes in into the organization from various subunits, sub-functions, complaints and the like under it. So all cash inflow added up makes up total inflow. As we have total inflow, so also we are going to have total outflow in a forecast. So all cash outflows must be added up to form our total outflow. Then we must not but talk about net cash flow when we are forecasting. So what do we mean? What do we mean by net cash flow in cash flow forecasting? It simply means the cash inflow minus the cash outflow. What we receive, which we can call the receipt, and what we expended, which we can call the expense. So now when we net them off, we have what we call net cash flow. Another thing that we will have in our cash flow as an line item, is closing balance. And closing balance is not as straightforward as opening balance. A closing balance of a cash flow forecast, we have the opening balance plus the net cash flow. The opening balance plus or added to net cash flow. Don't forget, when I introduced net cash flow to us, I said is the cash inflow minus cash outflow of a particular period. So let's say, for example, we are forecasting for this year now. So our net cash flow, our net cash flow, first of all, will be the cash flow generated or projected to be generated for this year, net of what we expected to spend on different departments and projects. So that is net cash flow. So we have our net cash flow figure there. Then to have a closing balance, we need to add our opening balance together with our net cash flow to have closing balance. I hope it's not a bit too technical. It's just the same way we say we had opening balance plus inflow minus outflow, then we have our closing balance. But to make it easier, our opening balance net of what has happened in the period that we are forecasting for will give us our closing balance. A cash flow helps the organization to really prepare for the future. Don't forget, the future is always now. The future is always now. The future we are talking about, yes, tomorrow we are talking about, is today we are talking now. So we need to plan, and when we are planning, when a business is planning for the future, we say we are forecasting. And when we are forecasting in relationship to cash, we are talking about cash flow forecasting. So this is one of the advantages of forecasting. It helps us to have a picture of the future of our organization, and it could be deficit and it could be surplus. So cash flow forecasting at the end of the day may have a deficit balance and may project a surplus forecast. So either way, it does not really matter whether we have surplus or deficit. What actually matters is the cash management. Cash flow and cash management, don't forget, they are the two topics we are treating together. An organization could project deficit. An organization could forecast in reality, could forecast surplus, could forecast deficit. So when deficit is forecast, then how are we going to manage the cash? So advantage of a cash flow is that it helps us to see a bit clearer the nearest future. So by assisting key decisions to be made, let's say for example, we projected we are going to have deficit. So we can begin to plan how to minimize the deficit. And at the end of the day, we may find ourselves to be on the positive side at the closure of the period in question. Also, when we have a cash flow forecasting, it can help us to answer some critical questions, which is very good for organization. Like, should we expand to another territory, to another jurisdiction, or not? Our forecasts can help us ahead of time to prepare for all these future events. Can we afford to pay bonus this year? Some people call it 13th month. So when we make a cash flow forecast, it helps us to manage our cash in these regards. And when we do this, know that people will be happy and production will be increasing on the increase side. So cash flow is a prediction. I want to believe that we agree with that. It's a prediction about the future successes and future seemingly challenges to be overcome in our business endeavor. Also, cash flow forecasting helps us or as a business to prevent insolvency, going bankrupt, because if we do not manage our cash very well, bankruptcy may be inevitable. Insolvency may be inevitable, but when we forecast ahead, it's easier for us to manage cash because we seem to have a bit of a big picture ahead of the events before they start to unfold. So this is another big advantage of having a cash flow forecast. It can equally help organizations to obtain external finance from financial institutions or from angel investors and every many other type of finance that we could be able to obtain. So many financial organizations, many banks will ask, where is your forecast? They want to see the last year's forecast, they want to see this year's forecast, and they want to see the actual in form of our statement of financial position audited and statement of income and expenditure or statement of profit or loss and other comprehensive income, as we now call it. Another benefit of having a cash flow forecast is that it helps business to predict if they can pay employee and vendors, suppliers and the like, and when to schedule payment. Also, it helps businesses to set targets to compare their actual income with the expenses against the forecast and to know whether we've done well in the period or not. So cash flow helps the Treasury departments to manage cash efficiently as possible as it is. It could be surpluses also are suitably invested because they know ahead that most likely we are going to have a surplus and they can easily deploy it to various investment options. Also, when we have shortfall, they can easily source out for maybe short-term fund and the like. Also, there is the level of mismatch is minimized in which we do not have sufficient or accurate nature of fund that could match the project at hand. We usually call it an organization as fall into mismatch. That is probably using a short-term fund to undergo a long-term investment, in which at a point the project gets stopped because there is lack of sufficient fund. But having a cash flow helps us, and especially the Treasury Department, to be able to look for the right source of fund that can assist the project. So cash flow forecasting is a critical and important aspect of treasury management. An organization must have enough cash at hand to deal with the projects and business, and you would not know we are going to need, because we can't just go to, let's say we want to go to exchange market. We can't just go there, and there must be planning, and for us to plan we must have known ahead of time. So treasury is very important in playing this role on our behalf. Risk management too. Let us squeeze risk management into the topic we are talking about. Risk, cash risk must be managed. Our cash risk exposure must be managed by a centralized specialist, which we call the treasurer or the treasury department. So this helps us to ensure that some people are, all they think about is how to manage our cash. When we have surpluses, they know how to deploy it on time so that it can generate more for us, apart from the efforts that we bring in on the production line. Because of the largeness of the organization, we said treasury must manage cash by pulling the cash together from various department functions, organizations, bank accounts and the like, so that we can have a unified figure and easily know what figure we have, let's say as at now or as at a particular period. We've mentioned also in forecasts we must have opening balance. What do we say opening balance is, and the difference between opening balance and the closing balance? What is the technical aspect that differentiates opening balance and closing balance? You can put it under comments. Let us hear from you. Then we talk about total inflow. We've spoken about total outflow and net cash flow. So we quickly run through all these key important feature of forecast. Cash pooling, we've said that pulling together or aggregating all the cash that we have, or even the deficit. Don't forget, when we are talking about the cash, we are talking about both surplus or deficit. We can be overdraft and the like together. So this is cash pooling. And opening balance is the balance we started with. A total inflow is all cash receipts in a particular period. Total outflow, they are all cash outflow added up for a particular period. Net cash flow, they are cash inflows and minus cash outflows. And we said when we are talking about closing balance is the opening balance plus the net of our cash flow. If you are just joining us on this channel, James Associate, and you are yet to subscribe, we had loved that you click it right away, please. And if you've enjoyed what you've heard and learned, don't forget to share this video and like it. It's important to us that you like this video. Comment if you have anything to say on the video, You can email us as display. And my name is Gbenga Olatunji, FCA, that has been speaking to you. Ggens Associates, we pride ourselves that we are value to life. We are value to your businesses. Please join us next time on another valuable, value-adding topic on Ggens Associate channel.